Welcome, everybody, to this webinar, Foundations of Technical Analysis, part 1 of 5 of this webinar series. We have a special guest, Patrick Ceresna from Big Picture Trading. I'm going to pass it over to you, Patrick.
All right. Well, thank you very much, Ryan. And hello, everyone. And thank you for joining me to learn about technical analysis. And we broke this up into a 5-part series. We really wanted to tackle how to really approach technical analysis. And rather than just trying to jam it all into one rapid session, we want to make sure we really understand. And the foundations in my mind are incredibly important. And so I'll take you through all of that right here. Just very quickly, I'm the founder of BigPictureTrading.com. Patrick Ceresna. You can follow me on Twitter as well. We have 2 great podcasts out there, Macro Voices and the Market Huddle. And they're available on almost all podcast players as well as on YouTube. So if you want to watch some entertaining shows on understanding the markets, please look that up. So let's very quickly just go through what we're going to cover, the agenda. We're going to understand technical analysis top down. We're going to understand the types of charts, time frames, trend lines, support, resistance, really give everyone a foundation. The first question we want to approach is why technical analysis. And in my view, there's always the perception that somehow by doing technical analysis, you are forecasting the markets like a crystal ball, that you know what is going to happen for sure next in the markets. And somehow there's this magic way of using technical analysis to do that. And I think that that's a misrepresentation of what technical analysis is. And so I hope to really give everyone a really good, solid understanding of why technical analysis, in my mind, is so incredibly important in a balanced trading approach. So I want to start off here and really start by just understanding the markets as a whole. And the first thing that I think that we all need to just accept is the fact that the markets are marked to market and prices are all marked to market on all stocks, which means that if somebody right now paid, let's say $100 for Apple stock, and that was the last traded price, suddenly everybody, hundreds of billions of dollars of Apple stock are all priced in your brokerage's account at the last traded price. It's all marked to market. And that is driven by liquidity. And a really simple way that a lot of introductory people can think of it is everyone understands real estate. You can turn around and list your home, let's say, for $500,000 because you feel from a value perspective fundamentally that that's what the house is worth. But if we come into a market where multiple buyers looking to buy the property, through price discovery and them competing in the bids, they may take that $500,000 house up to $600,000 in the bidding process. And that, once that sale gets completed, then that house becomes a benchmark value for all the other houses in the neighborhood that are comparable. And that's the process of price discovery and then all prices being marked to market. And that happens in stock market, real estate market, bond market, you name it. All markets, even currencies, all have this element to them. And so what it really does define, though, is very few people ever have the opportunity to buy at the very best price or sell at the very best price. Because the moment a stock is at its high, if everyone tried to sell and there was no one to buy, the price would simply not trade there, and it would drop immediately to discover where the buyers are. And so there's this element of that needs to be understood, is that when you see that, let's say, the stock traded at a 52-week high or a 52-week low, doesn't necessarily mean that there was ample opportunity for you as an investor to act there. Then this is where we'll talk about technical analysis and the application of it. But remembering that all prices are a function of liquidity. And liquidity, it's a word that you commonly hear, especially in the macro space, is really in the markets, the discovery of how much inventory of stock is available, how motivated are the sellers to liquidate the stock, how much money is in the market of the investors ready and able to buy, and more importantly, what is their motivation, or how motivated are they to buy? And the market is a perpetual and continuous balancing act of these sellers and buyers moving into the market to price discover what stocks are worth. So understanding this, let's go to understanding technical analysis. And like I said at the beginning, it is not a crystal ball. There is no way of knowing for certain what a stock will do next. There are no certainties in the market. So why is it therefore useful to have technical analysis? And this is where I want to really kind of bridge the idea. Why do we use it? What is the benefit of us using technical analysis if we can't know for certain what will happen next? And so this is where I always say that there's a very important bridge technical analysis fills. Now, fundamental analysis happens to be the most broadly and widely accepted form of analysis amongst investors and traders, and rightfully so. It is the process of understanding the businesses and companies themselves, understanding the value, whether that is of the individual company or how it compares to other competitors within its sector pairing, or what is the valuation of the whole market. It's looking for where there's opportunity from understanding the quality of the investments you own. But understanding the valuation of a stock does not tell you whether or not it is likely whether this is where investors are allocating capital. So technical analysis is the observation of the price movement themselves. Understand, you cannot have buyers accumulating a sector or a group or a stock without it reflecting in the price. And therefore, technical analysis is an observation of how investors are actually allocating money. And what you want to think is that you can identify a stock that's incredibly cheap, but if nobody is allocating money to that cheap stock can get cheaper or even stay the same for very long periods of time. And even though you have purchased something that is in fact of great value, it is not reflecting or rewarding you by rising in its price just because you identified it. And so technical analysis is, again, the observation of how other investors are allocating capital. It lets you get a gauge as to what is happening. And one of the most important things to recognize is the trends that are established in the markets, therefore reflect sentiment. Because if all investors are allocating money, let's say, to cannabis stocks, well, that's causing the price to rise and the trend to distinctly be higher. You can identify the sentiment that right now investors are bulling or advancing that segment of the market, and that's where investors are trading. And technical analysis is the process of observing and connecting that. And so I don't say technical analysis is better than fundamentals or vice versa. Actually, I think they complement each other very well. And having a very solid understanding of fundamentally what is value and identifying when other investors care about that value is a very great way of looking at the beautiful combination of fundamentals and technicals together. So investors often are irrational and behave in herd mentality. It's often called the Giffen good, which is this idea that the higher something goes in price, the more popular it is because it's making so much money that everybody wants to own what is hot. It doesn't matter what price it was. The fact that it was going up actually caused everyone to want to own it that much more. Similarly, into the reciprocal, what's amazing is that you can have a stock that's super cheap, and most investors just don't want to own it anymore because it's not going up, and they're seeing all this money being made in the market, and their investments aren't participating. And so even though it could be an extraordinary value, they will sell it just because they want to own something that actually is moving. It's this amazing irrational behavior in investors. And technical analysis gives us the ability to actually try to understand how this money allocation is playing out. Where is the money going? What is working and what isn't, right? And so technical analysis, in my mind, reflects activity. When we want to identify where that activity is, we need a tool to help us measure a risk-reward proposition. How can I manage my risk? The bottom line is you want to identify somewhere where you can define your risks, to the best of your ability, that is, and at the same time see the potential for reward or a return that is far greater than the risk you're undertaking. And by using fundamentals alone doesn't give you necessarily all the tools to be able to do that. Technical analysis is a phenomenal way of being able to put context and structure around your trade. Nonetheless, we can, with technical analysis, create an entry strategy of when we choose to get in. We can define where we will be wrong and how we're going to cut ourselves out with a stop loss. So those not familiar with a stop loss, it is an order given to the broker that if a price trades to that price level, then it triggers a market order that liquidates your position at the best available price. It doesn't guarantee you a specific price, but it is a mechanism that a lot of traders will use to define their risk and their losses. It also gives you the ability to set goals for profit taking. You know, you see that if the stock rises back to its major highs, that would have made you a great return, and you can use as a way of creating objectives of what you're looking for from the investment. And it also gives you the tactical ability to recognize price levels that make sense for dollar cost averaging or averaging down on an investment that may have started off on the wrong foot for you, right? And so the question is, how do you know where those levels are? This is what I love about technical analysis, is it gives us a structure to it. Not that it gives us a guarantee, but it gives us ability to make active decisions with some sort of context to it. What I want to now move on, and let's talk about how you can put these charts up in your TD accounts. And so what we're going to do is start off with understanding the types of charts, and we're going to cover the 5 types of charts that on the TD system they allow you to observe. And so we have the line chart, the mountain chart, and step charts. Now, the 3 of them have really fun names, but actually fundamentally they're the same charts with just slightly different outlays. And where we have a little bit different structures when we get to the bar and candle charts, which share a similar characteristic. So first of all, where are you going to find this on your advanced dashboard? What you can observe is if you go to the little settings key at the number 1, you can go to look at your view options and go to your chart types, and you can observe that you can look at line charts, the step charts, bar charts, candles, and mountain charts. So let's take a look at what these look like. And why you would consider using each one of these. Now, the line chart is probably the single most commonly utilized chart out there. And all that we're doing is taking the closing price of your underlying and plotting it back in the day before computers, they used to just do it on graph paper, right? And just plot the closing prices on a chart. And subsequently, you could plot all sorts of other things around there. But it just is a connect the dots kind of line that just demonstrates what the price is doing. Now, what you'll see is that when we go to the next chart, the mountain chart, it's the same chart. All we've done here is simply filled a color in underneath the line so that this perceives this mountain style observation. This is probably the most common chart to be used on news network stations. We tend to find that this is the most appealing for making observations about a stock. And so really it's the same as the line chart, but you now have just simply a filled color underneath the line to create that contrast. Now, where we have the same price point, but a completely different look, is what's known as the step chart. And really, again, it's the same chart. All we've done is instead of connecting the dots directly, all it does is uses vertical and horizontal lines to connect. So it won't do 45-degree angle lines. And so it always moves a step and then connects to the close, moves a step and connects to the close. And it creates the step kind of fashion. Some people that like to observe this kind of higher highs, higher lows, ebb and flow, find that the step chart gives them a better pulse on understanding the price action. Listen, this is, I'm not going to tell you that one of them is better or worse. In fact, one of the most important things to do is for you to develop your own style. And your own style has everything to do with how you best visualize and make decisions on the markets. And so if you find that this type of a chart appearance looks and feels better for you in terms of making your decision, all power to you. I don't think that you're going to make more money or lose more money using one type or the other. So this is where I want to get into bar charts. And so now bar charts and candles have a similar characteristic to each other. And what they do is rather than just using closing prices like our three prior charts we're doing, we take the 4 data points of the high, the low, and subsequently the open and the close. Now, so notice here that the open starts with a dash to the from the left, and the closing price is a dash cut out to the right. And what that does is it gives you the ability to see throughout that one time period what was the lowest that it traded, the highest that it traded, where did it open and where did it close, all in one data candle that you can observe. And so some technicians who want to observe the price action itself on an intraday basis feel there's more information by observing a bar chart versus a line chart. And I do believe that. I personally use candles, but candles and bar charts have the same characteristic. It's just preference. And on the advanced dashboard here, what they do is they color code these. So when the open is lower and the close is higher than the open, then they will color the candle green. Similarly, and to the reciprocal, when the open on the bar chart candle, or so on the bar, is the higher, and then subsequently the price closes lower, then what you're observing here is that they will give the bar a red color. And so what you'll find is that it looks like this on your chart. Now, notice that this chart of Apple was the exact same chart as what we use for the line chart, mountain chart, and step chart. But some people observe here a lot more little bits of information in terms of where the real reversal and distribution began on Apple and how it looks. And some technicians, we can get to it in other modules, will actually use this information as a tool for making actual decisions in the markets. Now, the final chart that I want to observe is the candle. And the candle charts have these little bodies on them. So what you can observe is that you take the exact same information as the bar chart. And what you will observe here is that you have the open and the close. And because the open and the close, the open was lower and the close was higher, then in this example I used white. Often it is filled green. And many charting platforms, you can make it any color you want. You can make it blue and yellow or whatever you want. But white and green are the two most commonly accepted candles for what we call an up candle, or a period where the price was rising during that sequence. To the reciprocal of that is the red candle, which is the price opened at the high, near the high. It traded as high as the high, ended up going as low as the low, and then closed near the bottom. Now, because the close was lower than the open, they filled the candle with a red color. And therefore, what you can do is color code trend. You know, when you see a sequence of white or green candles for the up, and they're going continuously every single day, is like an up candle, an up candle, an up candle, what you can definitively identify is that this is a stock that is being aggressively accumulated and being driven to a higher level. So what you can also in candle charting terminology, the little black line is defined as a shadow, and the white body, or the body itself, the color is known as the body of a candle. And so notice that from a price perspective, there's only two types of charts. There's the ones that just connect all the closing prices, and in terms of the bar and candles, they're using high, low, open, and close to construct the way that you're looking at the chart. So a candle chart will look like this. You can observe that on the TD Advanced dashboard here, that you are using a full-bodied green candle for the up and a full-bodied red candle for the down candles on there. And I personally like to look at the charts with candles, but again, it's up to you how in your mind you want to be able to approach this. So now the next component we want to talk about is how to change the time frames on your charts. And so this allows you to capture the time frame relative to your trading. So some of you may have the appeal of day trading, this idea that I'm going to just load up my computer for a couple hours, look for something that's happening, get in, get out, make some trades, and take my profits. So a trader that is trading on an intraday basis is simply not need to look at a year's worth of data. Similarly, a swing trader, somebody who is looking to catch the most immediate trend and may be in a position for even hours or days, might be out by the end of the week, doesn't, again, need a very large time frame. To the opposite, an investor, for instance, that looks at is a position trading, looking for much bigger picture trends, you're positioning yourself and making sure you capture enough time to understand what that bigger trend is. And of course, longer term investors are looking at big cyclical opportunities. And some of those will be using even weekly charts where each candle represents a week and trying to capture multiple years of data to try to really get a grasp on what is the underlying trend within that market. And so, and if you notice here on the dashboard, is that under the period, you can see that I had this chart that we were using throughout the last 20 minutes set at 1 year. And so you can observe on the calendar at the bottom that you're capturing 1 year of data on there. Similarly, if you look at the frequency, you can now look at that we are looking at a setting of day, which means that every candle represents 1 day of data, the open and the close throughout one trading day. This is by far the most observed time frame, 1 year with 1 day candles. But you, again, can customize this to your own style. And so here's an example. I chose under the period only 10 days of data on Apple, and I chose under frequency 5 minutes. So what you can observe with those lines that are cut there, I numbered at the bottom, is it captures 10 days. And those big gaps, let's say that gap between 1 and 2, where Apple was trading, let's say $205 one day and $215 the next day, that is a pre-market gap, where basically it closed one day at the one price and then shoots up and opens the next morning at a much higher price. And so on an intraday chart, you can really capture these types of moves. And so what you're observe here is that we only isolated 10 days, and we're looking at a frequency of 5 minutes, which means now every candle on this chart is capturing and creating only 5 minutes of data. What is the highest, the lowest, open and close that the price traded in that 5 minute time frame, and it subsequently puts in an entire days of 5 minute candles in each one of those slots. And so this is what a day trader will use. A day trader that is looking at capturing a short-term move will break it right down to an intraday rate like this and trade from that time frame. Now I want to move on to trend lines, and I want to capture probably the single most commonly used technical approach is to use a whole bunch of lines on the chart, and they're drawing these trend lines. And so trend lines are what technicians commonly do to identify the primary trend. They will connect a sequence of lows or a sequence of highs with a line to identify the direction and the magnitude and the steepness of a particular trend. Now, a common identifier when we put on trend lines, it is a good way to identify a shift in momentum, because the steeper a trend line is, then the trend line itself can actually be used to identify when the momentum of a rise has slowed, and therefore you're observing things like the magnitude or speed or the rate of change that is developing on a chart. And so let's illustrate this. I took the Apple chart and I went back to look at when it was in 2018, when it was going through a substantial rally from the months of May through to November. And so we're talking about a 6-month trend from which Apple was pretty much sequentially making higher highs and higher lows and rising. And what you can observe is that we essentially connected a sequence of lows. And when Apple finally broke below, we were able to identify that existing uptrend has subsequently ended. Many traders using technical analysis may often, from a risk management or money management perspective, choose to take profits and or cut a loss when if they were along the position and a trend line like this broke. Now, you can do that also as a buy signal. So notice here that during this decline, you were able to pretty much connect the sequence of highs with a trend line. And ultimately, once the 3-month downtrend ended, it actually offered an interesting reversal point where anyone that was either short Apple could have taken profits on their shorts, and or a new potential buyer or even an existing buyer, dollar cost averaging or averaging down, may choose to do some buying on that break. Now, again, trend lines, and I personally don't tend to make my trading decisions based on a break of one, but it is actually a great way for a beginner to just understand what is the primary trend that a stock is trading in. So one common misconception that I do want to give you a little tidbit of wisdom on is that a break of a trend line is not necessarily a guarantee of reversal of trend. I cherry-picked that Apple example where once the trend line definitively broke, it clearly began a new reversal that subsequently lasted for an extended period of time. But the thing is that trend lines, particularly very steep trend lines, can simply only mark a correction in a primary trend. That if, let's say, a rise in the stock was simply, the magnitude of the rise was simply very, very steep and very rapid, a break of that rising trend line may simply mean some short-term exhaustion and profit-taking, and to mark a more shallow slope trend line that will develop in the coming weeks or months. And so you don't want to just go as a beginner and assume that any trend line you break guarantees that major trend is over. You want to use a little bit more insights than that when making your decisions. So the final major part of the foundations of technical analysis that I want to cover with all of you is the understanding of support and resistance. And support and resistance is also a really interesting element to observe in the markets. And so how would I best define support resistance? So you're identifying price levels that trigger investor buying and selling. It is most likely attributed to the psychology as investors earmark previous highs and lows in the markets as mental high water marks. But I would say there's also fundamental reasons behind it. So let's say I'm a big shot value investor, money manager, and I do my fundamental analysis. And I determined that my stock XYZ is an extraordinary value in. I'm making up hypothetical numbers of let's say the $10 range. then let's say that money manager says his traders, if you can accumulate the stock in the $9 to $11 range, we fundamentally believe that this is a great place to accumulate a large line of the stock. And so what happens is that will manifest itself on the chart, because what you will see is that becomes support, that every time the sellers sell it down into that zone, there's now ample amount of buying to support the price there, because that big money manager is willing to do aggressive buying at that price. And so it has some to do with psychology, but also it can be fundamentally driven as well. And so often what you also identify is that what was previously resistance can become the new support, and vice versa. Previous support becomes resistance. And so let's understand what support and resistance are. What are these words? And so support is the previous lows that now act as a new accumulation point for investors that regret not having bought at that price level the last time the opportunity was there. And so let's say you saw your favorite stock that was trading at $50 trade down to 40, and intuitively you're like, boy, I probably should buy some. And then the stock jumps from 40 up to $43, $44. You're like, oh my God, why didn't I buy when it was down at 40? Now, the next time the stock drops from 44 down to 40, you remember the last time it was at 40, you wanted to buy. So now it's here and you're going to buy. What happens is that there's a psychological way in investors that are making active decisions why previous highs and lows have this weird way of playing these high water marks where investors remember these things. And so a break of a support level in this situation is often an indication of assertive distribution and a hallmark of downtrends. And so what you want to think is, if we can identify a key support level, if the selling is so aggressive or assertive, and I use the word I used here, that it forces the price to go through that support level, that is a hallmark of a downtrend where the stock is being very actively sold and some very large money is trying to unload the stock and are willing to do so at lower price levels. And we can identify that selling through the trend line and the break of these support lines. And similarly to the upside is resistance. And so previous highs often act as sell levels for investors. So when that, for instance, often may have regretted not selling the first time we saw it. So let's say we saw a stock that you were looking to sell trade up to $6 a share, and so you were thinking of selling, and then it quickly drops back down to $5, and you're like, oh, why didn't I sell when I had the chance when it was up at $6? Now, when the next time the stock rallies towards $6, often investors will remember and benchmark that previous high and say, well, I remember the last time I wanted to sell up here, I will. So there's a psychological element I'm trying to kind of build for all of you in this. And what happens is that when a resistance level is broken, especially if that resistance level break is to a 52-week new high on a stock, it is also, again, a demonstration of motivated buying. Bidders are bidding for a stock that there's less supply of and more buyers interested, and they're willing to price discover much higher to get their allotment of stock. And this is obviously a hallmark of that uptrend. And so what I have is a great little chart. I know, obviously, I cherry-picked a chart where this is very demonstratable, but this is Abbott Labs. And we're looking at 2 years of charts going from 2017 to its present 2019 levels. And what you want to observe here is that where all the previous highs during the 2017 part of the year, the two down arrows, that $56, $57 acted as an overhead resistance for the price back then. Then in December of 2017, when it was able to break above there, the stock rose to the upside. And now every time it came back down to 56, 57, it became a new point of accumulation where buyers bought the dip and accumulated the stock along there. What's amazing is that then you can identify that this then subsequently created a new point where the $64 to $66 area became new overhead resistance on 4 attempts higher. And subsequently, when in the middle of 2000 or late 2018, when it finally broke above the $64 to $66 level, then every pullback that occurred, that became the new support, the new buy level. And so there's this amazing phenomenon in technical analysis where previous highs become new support for lows and vice versa. And it becomes interesting levels that technicians seek to identify to be able to make more effective risk-reward decisions when, in fact, trading. So what you can then observe is that those highs that were established in late 2018 through the early part of 2019 now became the support. Now, even though there was a very temporary liquidity event that occurred in March that popped it below, you can see that on balance, the majority of the price action stayed contained within that support resistance level. And subsequently, when it finally broke out above those next previous highs, then that once again, the $80, $82 level became support resistance. And so there's this natural, in this case, what is a very definitive multi-year uptrend in Abbott Labs. It moved in a step fashion up and down, preceding higher highs and higher lows. And each time that overhead resistance that may have acted as an overhead resistance for many, many months, even a half a year or more, suddenly when broken becomes a new area for support. And so this is what I really wanted to leave you all with. It's just an understanding of the price action and the way things work. So how to set up your charts, what time frames to look at, how to draw trend lines, and how to identify support resistance. These are, I think, are the fundamental foundations of technical analysis. What we have coming up in partnership between Big Picture Trading and with TD is a 5-part series. So now that we've covered the foundations, what we're going to go into the next session in understanding technical patterns and understanding trading gaps and how they influence or how you can interpret them. We then, in the third part of the series, we're going to talk about technical overlays, the most common being moving averages, but there's a number of series of them that you can, and that's the different technical things that you can add to the main part of the chart. In part 4, we're going to get to indicators, and this is where you'll see things like, as an example, RSI or stochastics or MACDs, or just to name a few of different indicators and what they do for you. And in our 5th and final segment, we're going to be talking about creating a trade plan and understanding how to create a rules-based system. And so it's going to be an exciting part. I hope you join me for all of them. The one key takeaway I want to say is that a lot of people try to pick one or the other. They say, it's just fundamental analysis for me, or I'm just a value investor and that's all that matters. And other people are technical analysts and say, all I care about is technicals. I don't care about the fundamentals. But I believe actually a very well-rounded investor is one that is technically trading fundamentally good things, as I like to always say. You want to have a foundation of understanding what is fundamentally sound, what are the really good investments out there, but learning how to actively make good decisions about the investments you own. And I'm going to look forward to taking you through that part series as we go. So, and again, just to leave it with there, if you want to learn more about what I do, you can visit me at bigpicturetrading.com, follow me on Twitter at Patrick Ceresna, and certainly do listen to our podcasts. They are free on any podcast player and or on YouTube, called Macro Voices or the Market Huddle. And with the Market Huddle, my co-host Kevin Muir and myself, we have a lot of fun. We make it very lighthearted, and we get through some pretty heavy analysis of the markets while having fun. So I think that many of you may find that appealing. So do check it out. With that said, that is what I wanted to cover. I hope all of you enjoyed it, and I think we'll move on here to the Q&A.
We certainly will. Thank you so much, Patrick. We're going to move on to questions.